You double check, make sure you have the correct first name, last name, you're visible on screen. Let's see. So Tyler, can you just make sure your camera works? Yeah, I mean, the reality is we're going to see the math, most of the math, the second part of class. I may go over a little bit of the math outline beforehand, but I'll probably do it right before that. We're going to switch over from the closing disclosure to the math about halfway through. Tyler, can you hear me at all? Does your camera work? Perfect, thank you. All right, I think I get perfect. You guys look like you're ready to go rip it up on Thursday night here. Why do you have a holiday tomorrow? Right. I'm saying that sarcastically. You guys look pretty depressed right now. I don't know. Is it me, the math, or the? I tell you, we're getting it's raining really hard right now. They might get a tornado watch to Friday to 7 o'clock tonight. Everyone's Thursday. Yes, and is that something new, Lynn? Thursday. Is that like the last? And I'm saying new last 20, 25 years. I don't remember that when I was in college. I might have just skipped that. All right, so let's see. Just about ready to go over the next slide. So I got a couple of people popping in right now, but if you could just bring your attention to the slide, make sure your chat box is ready to go. And if you could, sorry about that. Everyone knows I'm on another computer. My other one completely died the other night. So I'm looking to my right. It's just my slideshow's not working the way it normally does. So if you could answer that, sometimes I might bounce ahead. If anyone's having trouble seeing that slide, pulling up your chat, using the chat hidden send, just let me know. As of now, everyone has sent to everybody. Anytime you're answering a question, make sure it goes to meeting group chat. So if anyone's having trouble using the chat, hitting send, just unmute yourself and let me know. We got a couple of Pennsylvanias, a couple of New Hampshires, mostly Connecticut. Okay. Mariah, are you here? Mariah? Okay. Would you drop something on the floor? I just want to make sure you did answer that question okay, right? All right, perfect. Okay. All right. So rules for this class. I'm sorry. I'm gonna do some double hitters on this a little bit. So rules for this class, you have to be in camera for the duration of the class. We will take 3 breaks. So first break's gonna be about 7:10, then we'll do 8:10, about 9:10. Give or take 5 minutes. Typically about 10 minutes before, I will say we're gonna take a break in about 10 minutes. If you can refrain from the be right back, that'd be great. And almost every time I say, can you refrain from the be right back, I'll also say, if your house is burning down, it's an actual emergency, take care of it. Right when I say that, we'll get 2 or 3 be right backs real quickly. The be right backs, all the time's tracked. So the idea is if you're not in the classroom, it's going against your classroom time. The 3 breaks are built in. So usually we have breaks about an hour and 10 minutes to 15 minutes into the hour. I don't do them right in the hour. Some instructors do. I go a little bit over. In my mind, it makes the last break seem like it goes by, the last hour will go by quicker because it's shorter than an hour. So be on camera. If you have to step away, be right back in the back. If you're not visible, so it's not necessarily removing the virtual background, just make sure you're visible. So make sure if somebody is in class that knows you, they'll be able to identify you. Be present for the entire course. Yeah, you're good, Sal. Be present for the entire course. Because right now, I'm not asking anybody to gamble, things like that, but if you had to gamble right now, and it was going to be what time, and don't write in the chat, but what time I'm going to end class tonight, there's only one time. It's going to be on time, 10 o'clock. So if you get bounced out at any time, that's right, Anthony. If you get bounced out at any time, just bounce back in. I don't control credit. I'm not saying if you get bounced out 2 minutes before, you're not going to get credit. But I'm just saying people get bounced out. I was worried about it earlier with the heavy winds here. Does happen, just bounce back in. Yeah, better chance of an alligator biting you and getting struck by lightning at the same time than me ending early. Okay. So if you get bounced out, just come back in. Be attentive. I always tell people, because people have always asked, so I just say it anyways. I don't care if you eat in the classroom. You're welcome to eat. I just don't want to see you making the food or having dinner with 5 other people. Passing the cranberry sauce or the roll or something like that. You can't be in a moving vehicle. It doesn't matter where you are in the moving vehicle. I don't know if it was this class or another one recently where a guy was spinning around the laptop, was trying to debate me that, he has the laptop because he's showing me, other people in the car and he's not driving, that should be okay. They just have a simple rule. You can't be in a moving vehicle. It doesn't matter where you are. If you are, we have to make you stationary. If you're 2 minutes, from 6 o'clock or something and you're moving vehicle and you're home in 2 minutes, I mean, that's not gonna be a big deal, but we can't let you in. Last night's class, we had somebody, are you here from last night? There was, I think it was either me or Tom said, how much longer are you gonna be in the car? He said 2 hours. 2 hours, and we just had to let you go on that one. So if you have any questions, I prefer you don't raise your hand in the Zoom, just ask in the chat. Because right now, I see many more people than I usually see, because my view is a little bit different. But there's 3 screens, so I'm only seeing a third of the people. So if you did raise your hand, I'm not going to see it. So I prefer you just ask it in the computer. I have no idea, Donna, because there's so many states, and it's very difficult to calculate that. I'll say people that try to take it within 45 days are going to have the best results. But some of these states, people have a long time to take it. So that really throws things off. So I would say what can help you the most is when you do go through these classes and it opens up on your end, really go through it again and study it. And the example I give, if I was going through chapter 11 and you went through that in a classroom and never looked at it again, just took the test, it's not going to help you. So for those of you in Connecticut, New Hampshire, this class is going to open up typically in 2 business days. Go through again and study it. If you're in Pennsylvania, you already have access to it. Okay, we'll go through that in a minute. All right, so if you have a question, you don't have to raise your hand, because I might not see it right now anyways. So when the moderator's not here, I'll be scrolling through all the time, but just ask it right in the chat. We got first, be right back. Under 10 minutes. That's pretty good time if you've got to be right back that quick. All right, so if everyone could write in the word, sorry about that. If everyone could write in the word example code, for some reason, me looking to the right caused me to hit the screen twice. I don't know why. Sorry about that. Okay. So everyone write in the word example code. This is known as an attentiveness code. So if you're new tonight, yeah, it's got to be a record. If you're new tonight, every class we're going to have a few of these. So typically we're going to have 3 to 4. So let's say 17 slides from now, you see a slide and there's a shape like that with a word in there. I'm going to just ask, are there any questions? So right now I'm not seeing the next slide because I'm on my laptop, and the view, what I usually see is just, it's changed a little bit in Zoom. I'm almost 100% the Zoom issue that I got to figure it out. So if you see a slide like this with a word in there, I'll ask if there are any questions. I'll count to 15 and move on. The idea is when you're writing this in the chat, it gets timestamped. So 25 minutes from now, if somebody puts an example code, that's not going to show when they go through it. It's great you did it, but it's not going to show. It's not going to count as an attendance code. So this class is considered national. So every once in a while, like last night, I went through the statutory period of time for adverse possession in Connecticut, PA, New Hampshire, just because it's there. Every once in a while, you might see a slide that will reference the 3 states. It's not common though. So this is national. So what that means to me and what it means to you is national content's open game. So that should say Connecticut, New Hampshire. Any questions you have on national terminology, national courses, I can answer them tonight. I cannot talk about state specific. State specific classes for New Hampshire and Connecticut given live virtual. So every section through, we offer those. Pennsylvania, it's self-paced. So Pennsylvania for state specific self-paced. Those classes are taught differently, okay? So if you're in Connecticut, state specific, it's all Connecticut. New Hampshire, all New Hampshire. Pennsylvania, it's on your own. Now, if you are in PA, you can take this class 100% live virtual instructor, 100% self-paced, or a combination. And you have access to take the materials at any time. For those of you that are in Connecticut, New Hampshire, it's 100% live virtual. Now, today's Thursday, tomorrow's a federal holiday. Typically, for those of you that, I'm not sure, Sebastian, because there's just so many different states. So, and I apologize, I should have just said that in a national class, I really can't talk about state specific. So this is a national class. I should have said I can only talk about national today. Every once in a while, a slide might reference the states, but I can only talk about national. And every state could have different parameters for the exam. So I showed you there are 80 national questions in all 3 states. But in terms of what else you have to do, when you have to do that, it's going to be done in the state specific. What state are you in, Sebastian? Connecticut. So you will have state specific with an instructor that will go through those sections. So for Connecticut, there's a 2-hour section, live virtual, and then there's a 3 hours. New Hampshire's all 2 hours. Pennsylvania's all self-paced. So again, if you're in Connecticut, New Hampshire, going live virtual, this class, it says there's typically opens up in 72 hours, but the reality is it's usually open up in 2 business days. So tomorrow's not a business day, federal holiday. So I would say it should definitely be open up by the end of the day, Tuesday. 95% of the time it's 2 business days. So if this was Tuesday and Friday was a holiday, it'd be open up by Friday. Sometimes it's earlier. So sometimes it's earlier, but typically it's 2 business days. If you don't hear by the 3rd business day that's updated shows you're taking the class, then reach out to the CE shop. Yeah, I probably am, Sebastian. I'm just not the only instructor, and I teach in other states. So I go by I'm old school where I'm supposed to be. I go by a paper map. So not paper map, calendar. So very well, I'm just not looking at that calendar right now. If you look at your Talkify calendar, it will show you the classes and the instructor, okay? So bear with me. I apologize. I'm looking to the right there. So if you could answer this question, please. We got a D in the house. So if you are a D, if this is your last day and you did make prior arrangements, you should have received the C shop capping down today. She got that package in the mail. You might have got it yesterday. So Shelly, about time. Where it's been so long, Shelly, I hope that thing's not collecting dust beside a bush or something. But typically the business day of, the business day before, you get a C shop cap and gown. If you check your email, you'll have 2 evites that you can invite just 2 people. We can't go more than that, just with the bandwidth to the graduation ceremony. So again, if you are having trouble using the chat, hit and send, seeing the slides, just unmute yourself, let us know. We can help you. So I'm going to go through this part of the outline later. So the math part of the outline, we're going to think of the math as a separate class. So we're going to do closing and settlement. Math is going to be a separate class. So it's kind of split up. So I will go through the math part of this a little bit differently. But if you look at this outline here, everything on here we talked about last night and a lot of the night before. So the math component, we're going to see another outline. And I'll go through just a few of the bullet points of it. But if we remember, we talked about title insurance. Just to review a couple quick things. Thank you, Matt, for putting that in. We're going to go through the closing disclosure. And if you remember last night, I put the link in the chat. So last night I put the link in the chat. I'm going to go into Consumer Financial Protection Bureau instead of going to the slides. So the slides are going to show the closing disclosure, but it's showing them filled out blank, filled out blank. I'm going to go right into the website, show you where it is, just so you're familiar with it. And I'll talk that out. But if I talk about title insurance, remember what I said, if you get a loan that's going to be backed by the government anyway, which means could be insured, guaranteed, provide liquidity, If you get a loan that's backed by the government anyway, you have to buy a lender's policy for title insurance. So you're going to have to buy a lender's policy if it's backed by the government anyway. Owner's policy is separate. So if you want to buy an owner's policy, that's on you. So let's say I bought a home for 600 and I borrowed 400. I'm going to be required to buy a lender's policy for 400,000. And as that loan's paid down, the value of the policy is going to change. How can you access the lesson plans from Tuesday? It should be Tuesday's probably open now, Anthony. So remember, when the PDF comes in here, this is a study tool for not tonight's class. The PDF is a study tool between class ends tonight and it opens up on your end. When it opens up on your end, you don't need that PDF at all. Everything's going to be there. So remember last night I went to a slide and I said there's videos, you're having trouble hearing it. It's like a 3-minute video in the PowerPoint. And I said, that's going to open up on your end. Watch on your end. I told you what it was. Remember that the last answer in that question, the appropriate one was title destroyed by fire. It doesn't matter. That has nothing to do with title insurance. If there's a fire and it destroys the title, that's nothing to do with title insurance. So you have the lender's policy, protects the lender for loan amount. Owner's policy protects the owner for their interest. So if I buy it for 6 and I put down 200, the owner's policy can protect me for 200 or for the whole house. You just have to buy a lender's policy. Now we're going to talk about the closing disclosure tonight. Closing disclosure is given to you 3 days prior to the closing. We will mention the loan estimate also. Both of these have been around for over 10 years. It's going to be 11 years, I think, in October. But the correct name, the test name, is the closing disclosure and the loan estimate. And most people in real estate, even though it's been over a decade, still call it the good faith estimate and the HUD. So those are just slang names that just people, just like somebody saying a video. I don't know when the last time somebody got a video was, but it's just a word they use. So we're going to go on that site. Now, couple things as we go through this. PITI. Remember, principal, interest, tax, insurance. That's considered front-end ratio. So when the lender is giving you a loan estimate, they're factoring all those things in there. And then a closing disclosure, they look at them and say, okay, did this line up? So PITI is a percentage of your income that goes to principal, interest, tax, insurance, also known as a front-end ratio. Back-end ratio is the percentage of your income then go to principal, interest, tax, insurance, and fixed monthly debt. So remember, fixed monthly debt, when the lender is qualifying you, they're going off a debt that shows up in a credit report. So if I said, what's fixed monthly debt? You could say student loan, credit card payment, car loan, personal loan, because those all show up in your credit report. Name some expenses in the chat right now that might be substantial, but they don't count as back-end debt. What's a lot of expenses? Yeah, daycare is the big one, right? Daycare, childcare, food, fuel. Yeah, gas, cell phone. Yeah, summer camps. That's a good one. Nobody's ever put that one in before. I like it. Yeah, car insurance, car payment. Yes, private school. You sending your kids to Cranbrook, Shelley? Yeah, all those things would be there, and that's what's confusing because when they qualify you, they're going off these national requirements. So they're qualifying you principal, interest, tax, insurance, fixed monthly debt. But many times, and they'll ask on the test, which of the following is not an example of fixed monthly debt? Somebody could have, a bad driving record, a lot of tickets, and their car insurance is more than their car payment. Or they don't have a car payment, but their car insurance is $400 a month. Javier, when you were on your way to the parade this morning, did you stop by Starbucks to get a pink drink and a scone? Did you go for the scone today? I don't like Starbucks either, Javier. I agree with you. So let's say somebody did go to Starbucks every day, and they're going. I don't know, what does a scone and a pink drink cost you at Starbucks? Like $15 probably. So if you were spending $15 a day at Starbucks, that's about $4.50 a month. So if you're always going there, that's $4.50 you're paying, but that's not back in debt. It doesn't show up in a credit report. So if it shows up in a credit report, back in debt. If it doesn't, it's not. One of the challenges, many times people say, well, I can't believe they qualified. They're only going by what they see. So when we go in Consumer Financial Protection Bureau tonight, I'm going to concentrate on the closing disclosure. But that's one of the reasons why they have that site in that agency, is so consumers know that they have to take their own step also. So the lender is saying, based on these guidelines, we qualify you for X. But you need to write down all your other expenses. What are some of these other things you're paying that don't factor into the financing part of it, but affects your ability to pay for the house? You know, if you're spending all kinds of money on car insurance and gas and food and fuel and things like that, I mean, that could be a lot of your expenses, but it doesn't show up. Doesn't show up. Now, does anybody remember what a point was? So this is just reviewing a couple of things from our previous outline. Does anybody remember what a point is in a loan? A point is a percentage of loan amount. And when you pay a point, you're buying down the interest. So where they always try to trick you is they say purchase price is $500,000. You're taking out an 80% loan of value. What would 2 points cost you? The thing is, points are 100% based on the loan amount. It doesn't matter what the house was listed for. It doesn't matter what it sold for. So if I said to you, a house sold for $500,000, what would 2 points cost you? I bet if I asked that earlier, a lot of people put down 10,000. You need to know what the loan amount is. You need to know what the loan amount is. Thank you for jumping on that seat, Joseph. So discount point, percentage of loan. Each point you pay buys down the rate about 1/8. If you were to pay points yourself today, if you're getting a loan, your first question a loan officer would be, if I'm putting up today's money up front, when do I get that money back? So if I'm borrowing $400,000 and I'm paying 2 points, that's $8,000. Yeah, paying $8,000. When do I get my $8,000 back? Because I'm paying $8,000 to lower the interest rate for the term of loan. So I'm paying today's money to lower my interest rate for the next 30 years. But you're essentially betting you're going to stay there for 30 years. Because if the rates go down, people might refinance. So think of somebody that might have in the last couple months bought, and they paid no points, they're at 6.5. And then maybe somebody else paid a couple points to get to 6. But let's say 3 years from now, the rates are in the 5s. It might be better off going from a 6 to a 5, but they receive no benefit by paying those points because they paid today's money up front to lower the payment on a monthly basis for the term of the loan. So if you're getting a 30-year loan, you're paying your money today to lower my payment for the next 360 months, next 30 years. But if you sell or refinance out of it, there's going to be no benefit from it. You're not going to see any benefit from that. Yeah, that would be 8,000 on that. Okay. So in terms of, I apologize. So where we see here, if you just look at that on that slide highlighted in red, we're going to spend a lot more time, Truth in Lending Regulations Z, the integrated disclosures, Consumer Financial Protection Bureau. That's the side I'm going to go into. I always remind people, Consumer Financial Protection Bureau is a government agency that helps consumers better understand student loan debt, credit card debt, and home loan debt. So you can, as a consumer, learn about any one of those areas in that site. That site was shut down several months back. Now, I'm saying several months. Was it 3 months? Was it 5? I don't know. Probably somewhere in between. So that agency was actually shut down, and there was a lawsuit. The federal judge forced them to open it back up. It's going back and forth right now. Some entities want to shut down, some don't want to shut down. If it does get shut down, the reason I'm spending time on this now, let's say it's a month from now or 6 months from now, it's not going to affect your test. So even when it was down, the closing disclosure, so you see under 2 where it says B and C, the loan estimate and the closing disclosure were not on the chopping block. So even though that agency was temporarily shut down, those forms were always going to be there. When we had the banking crisis years ago, a lot of consumers said, I didn't understand what I was getting involved in. I didn't know my payments were going to go up. I didn't know this was going to cost me this. So the government's answer to that was to really revamp the forms. And they spent a lot of time revamping it was originally the good faith estimate, became the loan estimate, and the HUD became the closing disclosure. And it's been like that for, I want to say it was 10 years in October. But it's one of these things that it probably should have been in place 14 years ago. They just kept delaying at the federal level to the point where everyone thought it was never going to take effect. And then all of a sudden, yeah, we're not delaying, it's taking effect tomorrow or next week. So if that agency shuts down, I think it's a coin flip whether it will or not. Those forms are not going anywhere, okay? The idea when they give you the loan estimate and the closing disclosure is you have time as a consumer to ask questions. So if you have any questions about the loan itself, with that loan officer, you have the time to ask questions when you're getting the loan estimate. 3 days before the closing, they're saying, here's the final figures. So a consumer might say to a real estate agent, what does this mean? That's something you have to talk to your lender about. So the government's essentially giving you 3 days to get all your questions answered. Because if you close in this loan, you can't come back later and say, oh, I didn't understand what I was doing. And that's what happened with a lot of people. Now, in fairness, the 3-day period used to be 1 day. And many times they weren't given that. There was no real penalty if a lender didn't give it. So if you know anyone back in real estate more than 10 years ago, the joke always was you could be going to the closing table, and I'm exaggerating when I'm saying it this way, you hear them typing that form in the other room. So meaning they hardly ever gave it to people the business day before. It was printing up while you're in that room. So now there's substantial penalties if they don't give it to you. If there's any changes from the original figures, they have to do a change of circumstance and then redisclose everything. They're not saying it's a great loan. They're saying based on what we see on our end, you're approved. But we don't know what you spend at Starbucks, the daycare, and all of this other stuff. The daycare we talked about being a new business with the, we talked about 1974 and the Equal Credit Opportunity Act. No, it's another business that you'd think was, if you said this to somebody years ago, you'd think this was crazy. What's another big thing that people might spend money on besides daycare Monday through Friday if they're working in an office or something? Does anybody have any ideas? Well, meal prep you could do, but yeah, parking's always been there. Gas we talked about, coffee we talked about. Happy hours are illegal in my state, Jasmine. Trying to bring them back. Yeah, those commuting fees, whether it's a surge pricing or something in New York. No, I was thinking of doggy daycare. Has anybody ever sent their dog to daycare? When I was a kid, you just let your dog out in the morning. The thing would go eat a squirrel or pigeon or something. It would find its way home. You know, every year the fire department would do a rabies clinic, and that was it. Yeah, dog walk is the same thing. Yeah, is the dog? How much is your dog? The boot camp cost, Anthony? $70. Yeah. I mean, I better get a haircut and a scone for this $70. Doggy daycare, for some people, that's part of their budget, but it doesn't. The lender doesn't know that because it doesn't show up on the credit report. But that can be pretty substantial. $70. It was much easier. We just let them out in the morning. They came back at night. They found their way back. They drink out of a puddle if they had to. Dogs back then too lasted forever. Now it's, I mean, the dog at the chiropractor and it's getting an adjustment, every 6 weeks or something. Yeah, all that's there. So this is all very heavily government regulated. So Equal Credit Opportunity Act, that was also from 74, where we said a lot of women were staying home with children because daycare wasn't a business and they didn't have access to credit because they didn't show a pay stub. So many years ago in the United States, to get credit, if you went to a store to apply for a credit card, and sometimes they had these credit card companies within stores. That's where Discover, the Discover card, came from Sears. That was Sears. Sears had a store card, and then they had a regular charge card, which was Discover. They later, sold it, and I think Discover just bought out Capital One, maybe. but you had to show a pay stub. If you were staying home with children, you didn't have that. That's why they put in the Equal Credit Opportunity Act. Everyone has an equal right to credit, regardless of your protected class. And mortgage fraud, predatory lending, we talked about that on the second day of financing. You know, they want us to be very aware: is there mortgage fraud going on? Are people lying about their income to get home loans? And if anyone, I don't know if anyone's in the car business. I never have been, but that's also something rampant where people just kind of making up any kind of number at all to qualify for a car loan, and might be losing it just as quickly. So some of these other things here, I'm just going to mention a couple quick. FHA. For FHA, I want us to remember, FHA does not give loans, they insure them. FHA has been insuring loans since the 1930s. One of the biggest fallacies for FHA, and something to be aware of and know for the test, there's no income limits on FHA. There's loan limits. So how much you can borrow in FHA loans based on where you live in the United States. So if you look at FHA loan limits 2026 in your state, it will show you based on where you live in the state how much you can borrow. Donna, do you think you get any more liquid in there or something? What do you need? 2 Teamsters to carry that thing? Hold up your cup. Everyone look at Donna's cup. I don't like to point people out like this. How many ounces in that thing? It's bigger than you. Right? That's what happened to cupping your hands together and just getting a sip from the sink. 40, yeah, I would say it's more than 40, but I'll go with it. That's why we got all the Be Right Backs here, the super cups. All right. So FHA, remember, on lender requirements, FHA insures loans, VA guarantees them. FHA loans are not income restricted. VA loans not income restricted. How much you can borrow in FHA is based on where you live in the United States and the type of property is pretty high. You know, FHA loans in some of the areas are probably close to $2 million on a 4-unit. VA, there's actually no loan limit. The biggest benefit of VA loan, you can borrow 100% of the purchase price. There's no loan limit for VA. They don't set one. So a lot of people think it's a small loan, it's in small income. No, there's no income limits in either one of those. Most lenders set on what's called an overlay, and they'll lend up $2 million for VA. So when you hear the term overlay, that's when the government's telling these lenders one thing. The government's saying to these lenders, if you do this, we'll buy this. We'll insure this, we'll guarantee this. But they'll put an overlay. So even though it's not a VA loan limit, they'll go $2 million. So when you hear something on the news about, let's say Fannie Mae getting rid of some of the credit requirements in desktop underwriter, that doesn't mean a lender's going to follow it. FHA, the federal government will insure an FHA loan with extremely low credit score, like the low 5s. But a lender is probably not going to do that. A lender puts in their overlay to make it a little bit tougher, okay? So any questions on that? All right, I'm going to go off screen for a bit just so I don't get a crook in my neck. And I will put in the link for Consumer Financial Protection Bureau when I go into that. But before I do, does anybody have any real estate questions at all? You can put them in the chat or unmute yourself. Anything that would be considered national? Does anybody have any questions, any thoughts on the market? Long-term, short-term? Sal, am I putting you to sleep? I usually don't do that. All right, there you go. Wake up. Thank you. You can go back to sleep for a little bit, just as long as you wake up quickly. Can you apply for FHA is you own, but you never use? Yeah, so the thing is, Anthony, where people get confused in that, most people think you have to be a first-time buyer to go FHA. That's not the case. But FHA has to be owner-occupied. So let's say I've owned a home for 10 years, and I want to rent that out and buy another home. I could, as long as I didn't have an FHA loan in the home I was in, I could get another FHA loan. So yeah, it must be owner-occupied. There's some very rare extenuating circumstances. Let's say you got an FHA loan and then your job was transferred. There's so many miles. You don't need to know this, but if I did buy a house FHA and then I got a job transfer so many miles away from my house, that allow me to go into another property. And I could still keep that FHA loan and use it as an investment. What they don't want to happen is you buy a multi and put down 3.5% down, and then you have no intention of owner occupying it. So you sign all kinds of documents. You're going to be owner occupied, et cetera, and that's it. And they're pretty strict on it, unless you get, let's say, you had to take care of a sick family member, something like that. They just want to make sure you're not buying a, because like I said, some of these FHA loans are in the close to $2 million on the 4 units. They don't want you buying an $800,000 multi with 3.5% down, and then you never live in it. When an investor would have put down 25, 30%, $250,000. So the thing is with that, Sebastian, I'm not an expert on that for any means, but I will say this. My two youngest are in a 2 unit, and the original house they wanted to buy was a 2 unit with a commercial rental attached to it. So they call it a mixed use. So 2 of the units, the original house they wanted to buy, 2 of the units were residential, and then there's a third commercial unit. Now, I talked to the mortgage broker. I know I'm not an expert. I'm not a mortgage broker, but I'm not an expert on the mixed use. But my understanding what I was told, so now they put down 20%, so they were conventional buyers. But I was told from the loan officer, and I verified some other people, just because I never heard of this rule before, that because of that was 2 residential, 1 commercial, they could go conventional if one of my kids would run a business out of there. So if the owner occupied used the commercial unit, you could go conventional. So even though they're putting down 20%, the only lender that would do that was FHA. It's just one of these odd things. Sometimes FHA will finance a condo that conventional won't touch or VA won't touch. There's odd things, but typically you wouldn't go FHA unless you were looking to put down the lower down payment. So if you had 20% down, you go conventional. But if you're looking to put down lower down payment, yeah, bought 3-family FHA, that's the way to go. I mean, buying a multi with FHA, that was the original plan with those two, was do an FHA multi rehab loan. But they lived at home alone. None of my kids have ever rented. So they were saving money. They weren't, they didn't go to, rent places too. One of my oldest went to college, the other two didn't, but they didn't rent at all. So the idea was go FHA, get a rehab, fix the thing up, but they didn't end up buying for a little bit later. And they watched that property I was telling you about. It came on the market and there was an issue with probate. So they kept watching that for a year. It's a great property. It was on a busy street, plenty of parking. So they each would have got a residential unit. And at some point, my youngest does have his own business, but he works full time for a company. But he does have his own, legitimate business. But he couldn't use that to say he was going to live in it. No. So VA. So here's the thing, and I don't want to confuse you. FHA loan limits are determined by where you live. So FHA loan limits are determined by where you live. So if you said Connecticut FHA loan limits 2026, they're going to show you every single town or county in Connecticut and how much you can borrow for a 1 unit, 2 unit, 3 unit, 4 unit. There's parts of the United States that are going to be specifically classified as high cost areas. So where you could go very high in those high cost areas. So if you're in a state where the prices are not as high, you're not going to be able to borrow as much on FHA as, let's say, California. So that's FHA. The loan limits are based on where you live and the type of property. VA, it's just one of these odd things. I mean, the big thing I want you to remember is FHA does not give you the loan. It's an FHA insured loan. So your lender is an FHA approved lender. The federal government insures it. People think they get an FHA loan from the FHA. No. It's a federal insured loan. The lender is an FHA approved lender. The federal government insures it. VA, the government guarantees a percentage of that loan. The VA does not set a loan limit. Now, that doesn't mean a local lender is going to give you a $50 million VA loan. It means there's no set loan limit. Most lenders, from my experience, and this part I'm going to say right now, you don't need to know. They set up an overlay of $2 million. So what I need you to know about the VA for the test is you have to be a veteran. You can buy a home and borrow 100% of the purchase price. So it's 100% loan of value. Just because you're a veteran, you don't have to go VA. But the other thing is the VA is not giving you the loan. A lot of people think, oh, I'm getting a loan from the VA. No, it's a VA guaranteed loan. So your local lender is a VA approved lender, and the VA is guaranteeing that loan. So that's the thing. Yeah, technically they have no loan limit, but it's one of these things that I'm telling you this because you need to know it. The reality is, test wise, this is relevant. The reality, I think any veteran that's going VA, they know what they can borrow. Now, if you're in an area where there's a lot of high wage earning government employees, so I always, and when I'm going to say this doesn't mean it's the only area, but let's say like Mid Atlantic, Virginia, there's a lot of high income earning government employees down there that a lot of them have military backgrounds. So you're seeing a lot of $1.5 million, $1.7 million, $1.8 million VA loans. Now, are VA loans easy to qualify if you're a veteran? Yeah, absolutely. But a lot of people just want to use their benefit. So they could be buying a house for $2 million and putting down $500,000, still borrowing $1.5 million. Well, in terms of the debt to income is what you can afford. So based on your debt to income, the fixed monthly debt, what you have to do is say, where in my state am I looking to buy, and what's the maximum loan amount? So if I'm looking to buy a single family in this part of your state, some states that the maximum loan amount could be in the 800s. Another state, more rural part of the United States, not as expensive, might be 550. But the point I want to make for the test is FHA is not, the FHA is not giving the loan, they're insuring it. When they created these FHA loans many years ago, they purposely said with FHA loans is we're going to relax the credit requirement and we're going to relax the down payment requirement. So remember when these started in mass in the United States, it was coming out of the Great Depression and also out of wartime. So back then, and I'm saying things the way I've taught them, I've been taught. So I'm not, the way I'm saying it, just take that for what it is. It's not a criticism on different things, but many years ago in the United States, when people went to fight in a war, they didn't come back until the war was done. So somebody from the United States could have got sent to war overseas, and they might be there for 2, 3, 4, 5, 6 years or more. So because of that, they're not building up any credit. Credit back then in the 30s were local businesses writing you a letter. Ken borrows goods on Monday, he pays them back on Saturday. Here's a letter, Joe the grocer. So that was a big thing. So if you were in military service, you were overseas for could be years. It wasn't like today, then the travel is different also too. So they need a loan that if somebody's come out of military service, they probably have no credit at all. They haven't been borrowing for local businesses. They have no pay stub. All their money was coming from the military. So the credit was tarnished. And because they're in the military, they might have been, spending somewhat money they had, sending money home, this, that, and the other thing. So they had very little put down. So even though there's the VA loan guaranteed by the government, FHA is insured, when people come out of military service and depression, they didn't have a lot of money saved up. They didn't have a lot of money saved up. They didn't have stronger credit. Thus, the FHA and VA were established with lower down payments, lower credit guidelines. So it made it much easier. And because of that, people tend to think it's a lower income loan. It has nothing to do with income. Now, somebody mentioned the 203K loan. So, Anthony, put FHA 203K loan and then a question mark. What's the question? Oh, no, my son's went conventional 20% down. But originally, I mean, that mixed use was in decent shape. But every day of the week, if I was younger, buy a multi with FHA rehab on a multi and then just fix that thing up. Because you're just it's relatively easy to borrow the money on those things. And FHA rehab, there's a full rehab. We can pretty much do the whole house over, but there's also a limited where you can borrow an extra 75,000 to, do capital improvements, roof, heating system, AC. So the FHA rehab loan, you have to know the dollar amounts for it. You don't have to know, but that's what, for them, that would have been the good option. The problem is my kids don't like spending money unless it's mine. So that's why I couldn't put down 20% when I bought my first house. I put down, I think I put down 5. Yeah, I mean, my daughter finally got off my cell phone plan when she turned 30 back in the fall. What was item number 5 in the calculations for real estate transaction list? I have no idea what you're saying. What was that on, Andrew? Was it on the slide? Oh, 2 slides ago. So yeah, I probably just didn't. Hang on, let me see. I probably purposely didn't go through because the math. So was it this one? Is it PITI? Okay. So yeah, PITI is a percentage of your income that goes to principal, interest, tax, insurance. So so some of these, because this part, we've gone through it another time. So let's say somebody's making 100,000 a year pre-tax. When they calculate your financing, it's always based on pre-tax. So if somebody's making 100,000 pre-tax, principal, interest, tax, insurance is also known as a front-end ratio. So we need to know what PITI is for the test. They might say using a front-end ratio of 28%. How much could you afford for PITI? So if somebody's making 100,000 pre-tax and the front-end ratio is 28%, that means $28,000 divided by 12. That shows you how much you can spend each month for principal, interest, taxes, insurance. So a very common front-end ratio is 28%. A very common back-end ratio is 36%. But that's not the only one. So when I do out the math here, if somebody's making 100,000 pre-tax, they always do it pre-tax. So if somebody's making 100,000 pre-tax, they're certainly not taking home that amount. So when you take 28,000 and then you divide that by 12, if you're making 100,000 a year, you could spend no more than $2,333 a month for principal, interest, taxes, insurance. If you did the back-end ratio, so this is here, but this was from financing that we did a 4-hour class on financing and a 3-hour class. So you will get that if you weren't there. So back-end ratio, the same 100,000, a very common back-end ratio is 36%. They'll tell you what one to use because there's different ones. So if somebody's making 100,000 times 36%, 36,000, divide by 12, that's 3,000 a month. So if you take the 3,000 a month, they can go to your back-end debt. So you take 3,000, you minus $2,333. That tells you can spend no more than $667 per month for fixed monthly debt. So if you have a car loan for $400, now you're down to $267. If you have a student loan for $300, you're capped out. So that's why. But yeah, so remember, some of these I'll purposely not go through. I'm only reviewing a couple of these things, picking out random because this has already been parts of that financing. It just between financing and closing, we have so much time on this. Is something missing on section D from the current slide? Are you talking about this one right here? Is this what you're talking about? Or was it the previous current slide? So I don't think so. I download mine from a portal. So before class, I always download something from Portal.
Now, Kenneth, it's the fact that right at the top of the slide, on the previous slide, there is a section where you can see where some writing is missing right above
Oh,
the
yeah,
inside
I'm
where it
not,
says
I'm
real
not
estate
100% sure.
calculations.
Yeah, I'm not 100% sure. It may be. I don't, but I'm not 100% sure. But what I do is I download from a portal, and we use this just as I always tell people, these slides are a study tool for you from the time class ends. So from the time class ends until it opens up on your end. So when it opens up on your end, that's when you're gonna see all this stuff. Okay. I'm just gonna get some people in from the waiting room here. All right. It's good. Tough time joining it. So that's why it's a study tool. On your PDF, there might be some things that are not on mine. And that's okay. So there might be some extra things for you to look at. But think of the PDF as between 10:01 tonight and it opens up. I don't want people really even looking at that during class because it's going to confuse you, because I'm going to explain things a different way than what you see there. But it's going to open up on your end. That's what you really want to go through. Okay. So as I get back here, this is the math one. So there's going to be this outline before we start math. If I go over this, if I have time to go over it, I will. But I'm not going to go over the same way as I do in the other classes. But a couple things to think about. When we do a math problems, I'm going to do some tonight as a math cheat sheet. It's a real estate exam, not a math exam. So a couple things to think of with that. No on to previous slide. So a couple things to think about that. If you don't understand math at all, you're talking about 6% of the tests. I can't spend more than just a little bit of the time on that percentage of it, because some of that's going to be on your own self-paced. If you don't understand math, concentrate on all the real estate stuff. It's not going to be really that difficult math, but the real estate terminology you need to know, or you wouldn't be able to get the math. If you didn't know points of percentage alone and not the sales price, I don't care how good your math skills are, you're not going to get that right. So a couple of things when we see here in terms of interest, fees, discount points, those are things we're going to commonly have for math questions. Prorated items under settlement. So typically you do, it doesn't matter what state you're in, you have some proration item. The most commonly item that's prorated on the closing disclosure is property taxes. So this is what we're doing in a little bit. So property taxes is the most commonly prorated item to closing. So if I'm buying your house and today is June 18th and you paid the taxes through the end of the year, you're squared up through December 31st, 2026. If I'm buying your house today, you're not going to be living there for the rest of this month, for July, August through December. So the town is not going to give you the money back. That's going to be prorated. So if you prepaid X amount of days, we'd figure out how much taxes are per day, and I'll pay that money back. Okay? That's a proration. Another proration that doesn't happen as often is a rental property. If you're buying a rental property, same thing the 18th, and the owner of the property, the seller, they collected rents on the 1st for all of June, they would pay you back for the monies they weren't there. They will say on the test, day of closing belongs to the landlord. So then you'd have to reimburse them. Are we all getting coffee this late? Was that a question? Did I miss the slide? So here's the objectives. This is the second part for the math though. So closing the transaction. They think it's a check-in. Yeah, you're right. Who started that, Shelly? Somebody just started that recently. I've been doing this for a long time, but every once in a while, somebody starts a new system. And that's what happened. A few weeks ago, somebody put a random word. So everyone put in coffee now. Just throw the moderator off. So closing the transaction. Some people call it closing escrow. Some people pass in the papers. Some people call it settlement. When the buyer gives the seller the rest of the money for the house, and the seller gives them the deed to the property, transfers the title, that's closing. So closing, settlement, escrow, passing, and papers all mean the same thing. It just depends where you are, what they're more likely to call it. Okay. So think of this: the seller gets the money, the buyer gets the title. Now, when I'm saying the purchaser gets the title, in some states, that's an actual physical document. So in some states, when you buy a house, you actually get a physical document. You're holding the title. Other states, it's just recorded. So in other states, you might have the title, but it's just recording somewhere. Not something you actually have. The example I gave in last night's class, I said if you're buying a car and you're giving the seller cash for the car, they give you a receipt with a car that's known as bill of sale, and they sign the title over to you. Then you get the title put in your name. With a house, some states you get a title, some states you don't. Some states you get a title when you buy the house, even if you have a loan on it. Some you might not get until you pay it off. That's different state to state, but know what the terms mean, okay? Now, if you could answer this question, select the answer most represents your experience closing real estate transaction. When I got involved in real estate, I was right out of college. I had none. So I was E. I sold the home before I owned one. So make sure you put something down. So yeah, we have a lot of E's. And there's nothing wrong with that. I had no clue. But one of the things you can do if you've never been to closing before is just when an agent's going to one, ask if you can just attend. And not that you're really real estate agents that closing, for the most part, they're just sitting there. If they might, maybe there's a question coming their way, but everything's done between the closing entities and buyers and sellers. Some states, real estate agents are required to go to closings. That's not the norm, though. Most times they go just as a courtesy, but there's a high percentage of times the buyers and sellers won't even be there. The seller is probably more likely not to be there than the buyer, but sometimes it's both. But more often than not, the seller's not there. They're just going to have somebody be their power of attorney. All right. So RESPA. So where it says Real Estate Settlements Procedures Act, that's more commonly referred to as RESPA. So Real Estate Settlements Procedure Act, you might see that reference in a question on the test as RESPA. This is designed to protect home buyers that require disclosures that educate them about real estate closing services. Now, I'm saying this as an instructor. When somebody is giving these forms, the forms are there to educate them. They still have to educate themselves. So when the lender is saying, okay, you qualify for this, you as a consumer still need to decide, can I actually afford this? You'll hear all the, and this was the big complaint where a lot of people got foreclosed on short sale many years ago, that people said, well, it was their fault. I should never qualify for this loan anyways. On paper, you did qualify, but they didn't know you were going to Starbucks every day. They didn't know your doggy daycare or childcare. They didn't know your gas tank got 2 miles per gallon, or you spent all kinds of other money. That's where the consumer has to educate themselves. So they'll have a bunch of budgeting tools on here too. And it's an agency, federal agency designed to help consumers better understand credit card debt, student loan debt, home loan debt. Those were the 3 areas that people complained to the government for, back 20 years ago when we had a lot of issues with mortgages, especially with student loans too, and credit cards. This is how we qualify you. If you go on Fannie Mae's website, they have all their guidelines on how to qualify. And that's why qualifying for a home is very easy, because they know you still have to make the income and have the credit, but they tell you what all their guidelines are. They're pretty much posted. Now, Leonard could put an overlay, but they tell you exactly what you need to do. So this is up to the consumer. It's not the bank's business. The loan officer can't ask you about your own personal expenses. Do you like to go out to, happy hour? And they don't have that in my state, but you like to go out happy hour, how much you spend there? It's none of their business. It's up to the consumer to research that and say, okay, this works for me or this doesn't work for me. And they're giving you 3 days to finalize that now. Before it was 1, now they give you 3. It eliminates kickbacks and referral fees. A kickback is an undisclosed form of compensation. So sometimes people ask, can you refer somebody to a lender that you know? Yes. If you're referring somebody to a lender that you know, that's absolutely fine. If that lender is giving you money back and that's not disclosed, that's a kickback. That's illegal under federal and state law. So if you have a friend that's a loan officer and you're referring business to them, they're giving you some money, nobody knows about it, kickback's illegal. What is allowed, though, if you remember from the antitrust, and just always remember, if you're in a class for the first time, we're always going to be talking about things that are covered. There's no class 1. You can't do class 2 before you start class 1. So you'll always hear this again. Under antitrust laws, the federal government allows real estate companies and other companies to have what's called controlled business arrangements, also known as affiliated businesses. So an affiliate business or a controlled business arrangement is when a company has a financial interest in some other provider, like a mortgage company or insurance company. So if they do have that, they need to disclose that to the consumer so the consumer knows if I use their mortgage services, they're going to financially benefit from that. It's disclosed, so it's not a kickback, okay? Kickback's the undisclosed form of compensation. Now, this is administered by Consumer Financial Protection Bureau. Consumerfinance.gov. This agency, several months back, was shut down temporarily, and a judge forced them to open it back up. They've been battling back and forth. Whether it closes down or not, though, I just want to make sure we're clear, the forms that we need to know for the test are not going away. So when they were temporarily shut down, those forms weren't going anywhere. There was never a talk that says, okay, we need to get rid of these new forms. It's a more in-depth version of the older forms. In terms of requiring buyers to use specific title insurance company, they can't be forced to use a specific title insurance company. And the rationale for people doing that sometimes was the thought was, if they force them to use this title company, maybe they'll see something a different way than we do. Now, maybe by forcing them to use that, when they see it a different way, they'll let something slide that shouldn't slide. That could be a title issue. So remember, we're going to try to break in about 5-6 minutes. It prohibits lenders from holding excessive escrow. So let's say my tax is $500 a month. They can't charge me $1,000 a month for escrow. So they're regulated. They also have to do a regular escrow analysis. Do you have enough money going in escrow to pay for your property tax and insurance? If your loan gets sold, they need to notify you. And today, if you're paying one servicer and you're going to pay another servicer, they do notify you, but they also, and what I'm going to say now, you don't need to know. There's limitations of when they can mark you late, things like that. So there's kind of a grace period if it goes from one service to another. Most times when you buy a property, though, they're going to tell you at the closing, here's the percentage of loans we sell in the next 0 to 12 months, and then from time periods from there. The majority of the time when loans get sold, nobody knows it because they just didn't pick up on it because they're paying the same servicer. You keep paying Bank of America. They could have sold that loan 12 different times. I mean, that's the difference. Your loan could be sold 12 different times. You pay Bank of America 20 years. Many times, these lenders that have big servicing departments, they keep the servicing rights. Credit unions are famous for that too. Credit unions pretty much, their home loans, a lot of these credit unions will sell 100% of them, but they retain the servicing rights. So you think as a consumer, oh, the credit union kept mine in-house. I like that. I can go down there and pay it. They just kept the servicing rights. So they're collecting the money from you. They take a fee for collecting the money and then send it to the investor, whoever's going to own that. Okay. So in terms of closing disclosure, I'm going to take us up to the closing disclosure on the slides, and then we come back from break. I'm going to go into a couple of things and then go right into the site. I'll go on the site where this information is. So the debit is something you pay out in closing disclosure. So the closing disclosure is a final reconciliation of all the monies. And debit is something you pay. So think if we're looking to closing disclosure, things that the buyer pays is a debit, things that the seller pays is a credit. I mean, the seller receives. So the purchase price, sorry about that, the purchase price is a debit to the buyer. The buyer's paying it. The purchase price is a credit to the seller because they are receiving it. So the seller is receiving the purchase price, that's a credit to them. The buyer is paying it, that's a debit to them. That's a debit to them. So I'm trying to I'm going to be putting in this link that we're going to go to after break. So I just have it in now. Hang on. So I'm going to put this in. Can you touch on seller credit? Sure. So this is what I'm going to go into. So seller credits can be for different things. And there might be language of how the lender wants that worded. So for example, it might say seller to pay $5,000 towards buyer's prepaid and closing costs. That's a seller credit. Seller could give a credit also for, we're going to give a $5,000 credit for new carpet. The problem with that is a lot of lenders don't like seeing that. So if the seller says in the MLS, we're going to give a $5,000 credit for new carpet, they typically make it towards closing costs or prepaids. Because otherwise, if they're giving a $5,000 credit for new carpet and it's not done prior to closing, they're going to need to do a holdback. And whatever the cost of it is, they usually do a 1.5 holdback. So if it's a $5,000 repair the rugs, they're going to need, or replace them, they're going to need 7,500 held back. So a seller could give a credit for something like that. Typically, though, they'll say, let's put it in towards prepaids, closing costs. Different loan programs allow for different seller concessions. Okay, a builder could give an allowance for appliances too. But typically, if you're asking the seller to pay something, the lender is going to say, here's the language you need to use. It's very common, especially with FHA loans, for the buyer to pay some closing costs and prepaids. And I want to say, what I'm going to say now, you don't need to know, but I want to say they can go as high as 6% for concessions on FHA. 6% towards concession, which is crazy. You only have to put down 3.5%. You get more in concessions than you put in down payment. So sales price, remember, is a debit to the buyer out of their pocket, credit to the seller. So purchase price right here, let me just write in question. Don't answer this yet. The purchase price is what? What would you say that is? It's definitely going to be B because it's debited to the buyer, credit to the seller. The purchase price is coming out of the buyer's pocket. The purchase price is being received by the seller. Okay, so it's going to be B. I'm just going to go to a new question. So on the next one, the new loan amount. So remember, the buyer is buying the house and the buyer is receiving a loan to buy that. So if I said the new loan amount is what? Who's receiving that? Who receives the new loan amount? A lot of people do get this wrong. The new loan amount is not a debit to the buyer because they're receiving that new loan amount. Okay? So the new loan amount, the buyer is receiving a loan from a lender for $300,000, and they're going to use that to go to the purchase price to buy it. And everyone confuses this one. The new loan amount is credited to the buyer. So it's credited to the buyer, debited to the seller. Okay? So next question's coming in. We're going to break very shortly. The seller's existing loan. So remember, the seller's receiving the purchase price. So let's say the seller receives $200,000, but they have an existing loan of $100,000. So they're receiving $200,000, but they still owe $100,000 they got to take care of. So what do you think that's going to be? Seller receives the purchase price, but if they owe their lender any money, it's going to be debited to the seller. That's going to come out of their pocket. So just make sure you put something down. I'm more concerned that you always answer a question. But I'm not necessarily going to check the answers. We're going to check from where I do question. So very close with a couple more of these, and then I'll show you where I'm going to change over. So when I go into that website, all I'm doing is mirroring the slides that are on here. It's just the slides here are, it's not as easy to show them, and they're showing a bunch of blank ones and filled out ones. So I'm going to just show you that whole site where that is. All right. So next question is coming in. Are there any questions? Okay. So where you see this form here, closing disclosure, when we come back from break, I'm gonna show you these slides, but quickly, and then go into the site. And the site will be that link I put in your chat. So all it is in your slide is a blank version, filled out, blank, filled out, blank. All it is a closing disclosure. You as a real estate agent, there's things you need to know about this form, and there's terminology you need to know in this form. There's terminology you need to know here. But you would never fill this out. You would never answer questions on that, okay? So just don't answer this one. I'm going to come back to, once I go through, hang on. Once I finish going through this, I'm going to go back to that form. We'll see the tenant's code and then do a couple other things. So yeah, I didn't want you to write that down. That's my fault. I'm on like a brand new laptop, but there's an issue with my Zoom. So I'm on another computer that's different from where I'd see you. So if everyone right now why don't we just do this? Why doesn't everyone write in the word math? Okay. Write in the word math, and we're going to come back at 7:27. When you come back in, write push or pull. Do not sign out. If you get bounced out, bounce back in. I'll let everyone in from the waiting room. So 7:27 will come back. Perfect.